to all the participants present here. Normally, I don't prepare my speech. I give extempore speech because this is a technical matter, I have to speak very carefully and cautiously because I can see that a lot of knowledgeable people are sitting in the audience and I don't want to get off guard. Still, questions will be asked, I know, but I'll try my best that questions are minimum. So welcome again. We have a very seasoned group of speakers in this session. Before we start, I would like to give a brief sketch about them. Mr. Travis Short is currently VP Strategic Analytics at Pacific Life Re London, and he has over 16 years of experience in various actuarial functions. Previously, he was the Director of Research and Development based in the Singapore office, where he was responsible for best estimate assumptions. He has done a lot of other roles in the US life insurance market. Moving on to Ms. Sujin Park, she has more than 20 years extensive experience in life and health underwriting and claims, bringing a wealth of knowledge and expertise, having held key positions at insurance and reinsurance firms. She is responsible for leading, developing, and implementing Pacific Life Re's underwriting and claims strategy across Asia. Ladies and gentlemen, request you please give them a good round of applause before we start the session. This session is basically back to basic session. Frankly speaking, we have attended 2 previous sessions. They are very advanced sessions. So it is important that in actuarial science we talk about mean of revolting tendency. So we have to come back to the basics, hence and forth. So this session is basically synergy between pricing and underwriting in life insurance. One actuary told me, I can price a product in which insurer will never face a loss, but I can't take a guarantee that it will be sold or not. One actuary told me, I can price a product which everybody will purchase, but I don't take guarantee it is profitable or not. So what is right? We may talk about models, we may talk about projections, we may talk about a lot of actuarial concepts. But it is important that in order to become a successful actuary, you need to understand the business. And premium is the first inflow that comes to the company. And that gives salary to everybody, including the actuary. So it is important that when you decide about the premium rates, you should be very, very clear whether those rates are competitive, those rates are marketable, and you have people in the market who can purchase your product. Moving on, so this session is synergy between pricing and underwriting in life insurance. And this is the part I have noted, it's not my own speech. So in life insurance, pricing and underwriting synergy occurs when underwriters' risk assessment inform pricing decisions and pricing strategies influence underwriting standards, leading to better risk management and profitability. So underwriting is a tool through which you can make your experience better, you can have better profitability. The synergy between pricing and underwriting lies in the use of data and analytics to inform both processes. And remember, whenever you are designing a product, anything, you have to keep customer at the center. This is the era of customer centricity. Therefore, by using underwriting data to refine pricing models, insurers can also improve the customer experience by offering more competitive and tailored products. Now, without taking much time, I will request both of the presenters, so please start the presentation.
Thank you, Pankaj, for that introduction. Pankaj mentioned currently based in London as a VP of Strategic Analytics, and so I'm an actuary by background, but manage our data science and analytics team. I'm from the U.S., as Pankaj had mentioned. I was speaking with him earlier, and I said, well, I'm from Kansas. And nobody's ever been to Kansas, so I almost never say I'm from Kansas. I always just say I'm from the U.S. She lives in Kansas. Pankaj says, I've been to Kansas. So it makes sense. The National Association of Insurance Commissioners is based in Kansas City. So as a regulator, Pankaj had the opportunity to visit Kansas City and some of the other state regulators around the U.S. When I left Kansas, the hot topic was, why are we doing so much underwriting? It's how do we accelerate this? How do we get away from medicals on almost everybody? And so how do you get from physical medical exams to using a more data-driven, accelerated approach at the point of sale was the topic then. When I moved to Singapore, I was like, almost no underwriting. How does this work? Very limited underwriting, that you will accept people at, so to say, a standard risk based on application form disclosures only. For me, that didn't seem to make sense. Ever since then, we're collecting more and more data on how this works in underwriting, and that's what we're going to talk about today. So as actuaries, at least in my career, started at the end of this funnel. And so this is the idea of selection analytics. Who ends up in an insured pool? So you start with the population, and if you're going to insure everybody, you got to be very creative in terms of how you think about this funnel. You need a funnel that works for everybody. So if you start at the top of this funnel, you're going to come through who might buy the insurance, who's going to show up to talk to the agent. Who is that agent? Is it bank? Is it IFA? And then, of course, key topic for what we're going to discuss here, how is it underwritten? Who buys the policy? And then once you get to the actuarial side of it, typically you have standard, rated, non-med, medical. What we typically don't have is a lot of data captured from that funnel, for example, in our experience studies or in our lab studies. Enjoyed the prior session on more complicated models, as was alluded to earlier. If you're going to use those more complicated models, we got to think about how do we get more data out of this funnel to better explain what's standard, what's substandard, and who doesn't buy the policies, whether that's because they're declined in underwriting or because they just chose not to take up the policy. So I've never understood what a standard risk is. Sujin, can you explain that to me?
Yeah, but actually the concept of the standard is not fixed, definitely, right? So maybe I can take a very obvious example with the SI product, simplified issue, which is very common in some parts of the Asia, like Korea, Japan, maybe Singapore, Malaysia, right? So in SI product, simplified issue product, our pricing colleagues already assume like some people, like mildly impaired people buy the product and pass the application process, right? That's why we offer the simplified questionnaire for that product, right? So as an underwriter, we should be comfortable with accepting some people with hypertensive conditions or with the high lipids, with some thyroid conditions. So maybe normally we are not very comfortable to accept them as standard in full underwriting, but in SI product, those are also the standard group of people, so we should feel comfortable. Also taking another example with the Indian context, I found very interesting in Indian market. So underwriters here use locations and education level as one of the key risk factors, right? Yeah, so if you bring the same profile to other countries like Singapore or Korea, saying like some people in the tier 2 cities and who are not like graduates, maybe they are just standard in other countries, like, they can be even preferred life as long as they don't have any disclosures, right? So it really depends on what is your situation, where you are, and what is the product and benefit you are offering now. So the concept of the standard is really different depending on the situation. So the key is like you understand what is the pricing basis, and the key is the alignment between underwriting and pricing.
When we're pricing business, it always starts with experience studies. As an actuary, you know I'm in the right profession because mujhe experience studies pasand hai. No matter what, even if you capture a lot of data about underwriting, classical problem is where actuaries are driving the rearview mirror. It's a good, bad problem in life insurance. It takes a long time for people to die who buy insurance. And so oftentimes you're going to have to wait 5, 6, 7, 8 years before you understand what happens with the cohort of business. What's happened in between? So obviously, mortality trends are happening. If you're here for mortality trends, I think that's next door. And then underwriting is evolving. And how do we then look at data-driven approaches to understanding how to make underwriting adjustments in advance of the long-term experience emerging? So I have an example here of a few years ago. We're looking at an experience study in the UK where the proportion of rated lives over about a 7-8 year period almost doubled. So what happens when your standard pool goes from 90% of the policies you place down to about 80% of the policies you place? Does that mean there's just more rated lives? The rated lives stayed constant. People were more likely to purchase the policies. Did Sujin work with some research and sharpen some of the ratings? Or was it that there were rated lives who are ending up in the standard pool that are now getting pulled out? And so these are questions we asked ourselves. And now, of course, as a reinsurer, we're thinking, can we sharpen those standard rates a little bit? The standard rates is going to help us bring the rates down. The insurers are going to like it. And so we had a lot of debate. This debate was very qualitative. It was very much an art in terms of trying to understand exactly what happened, because we didn't have data from 2013, 2014, 2015 in terms of what actually was happening on a policy-by-policy basis. This was before everything was going digital. This was before data capture was disrupting the industry. It's not exactly a new topic. I actually was searching for some past information on pricing and underwriting working together. First thing I found is the Society of Actuaries panel transcript, which said, in the 1980s, as never before, it's essential for the underwriter and actuary to work hand in hand. And then I was going to read some Indian mortality papers, and I found an Indian mortality paper from 1938 explaining the preceding decade of mortality, in which there was significant debate back and forth from the author and then in response letters thereafter on how long the selection period lasts and is medical underwriting worth it. The author was saying, I don't think the selection period is that long. Here are some data to show it, and I think we should stop doing it. So this debate's been going on for nearly 100 years. Both those papers also debated technology and how we're going to get better at capturing data and better understanding these things in the future. So the mornings I wake up and play around with the Gen AI tools and think, okay, we're going to be out of profession within a year or two. It's good to go back and read some of these papers. We're going to look at 3 different examples of how we look at some of the data that happens in that funnel. And so Sujin's going to introduce the next one.
Okay. Yeah, as Travis mentioned, we brought 3 the cases, and hopefully that gives you some idea like how the underwriting and the pricing can talk each other, and especially like how the data can make underwriters' job easier, and also when and how the pricing actuaries should engage underwriters in terms of dealing with the data. So the first use case we brought is about the underwriting impact analysis. So all the example here comes from our UnderwriteMe experience and the data, and UnderwriteMe is our automation solution. So let me give you some context first. So one of the key jobs that underwriters do is to change underwriting guidelines or the underwriting questionnaires or processes. So we want to stay competitive in the market, so we do a lot of the changes, right? But to be very honest, sometimes actually we change just because other competitors changed, and we don't know what's the impact of those changes that much, right? So because of it, we cannot be the market leader sometimes, we cannot be bolder. So that is our pain point, right? But we can do better, maybe.
This is an underwriter and actuary working hand in hand. So this is an example we looked at where the example occurred about 5 years ago. We noticed it about 4 years ago, in which we're looking at mental health disclosures in the UK. And so you can see here what you have right there in early 2020, about March of April 2020, you see a spike in mental health disclosures. This is as self-disclosed on the application form. And so what happens when you go from 10% of people disclosing some sort of mental health condition to 15%? Well, what happened 5 years ago? Was that everybody went in lockdown, and suddenly, since you're in your own house all day, that you're a little more aware of your mental health and that this is creating anxiety and depression? There are some retrospective papers that show that did happen, but at this time, we said, okay, 5% more people disclosing. These people are getting pulled out of the standard pool. Does that mean we were making a mistake before? Do we then think to adjust and reduce the standard rates? Are the ratings that are being put in now correct? And so these are the types of things that we have to debate, given that we've seen this. So we worked with the underwriters to figure out exactly what happened.
Yes. So what really happened in UK at the time was like there was a very large catch-all question, but the company decided to separate them into a few different detailed questions. And one of the questions was about the mental health conditions. So naturally, that led to the higher disclosure rate, and that's what you are seeing now. But here again, I can emphasize what's the importance of the data here for underwriters, right? So again, we can discuss with our pricing actuaries what's the impact of those changes in application form, how much disclosure we get more. But still, we can also debate more what is the fundamental cause. Maybe some is the behavioral economics, like having more detailed question, and some could be more from the environmental thing, like a COVID, as the Travis mentioned. But gradually, maybe, yeah, over time, as we monitor the data more and more, maybe we can form up the view better, right? And also, in the future, in case we see that the disclosure pattern also changes again, for example, we see the lower disclosure rate than before, like more closing to the pre-COVID rate, then we can guess like maybe the impact was more from the external, like a COVID one. And then we can also make a decision, like an action, additional action, like, or maybe we want to go back to the, the catch-all question again, because the shortening the question, meaning that the better customer journey. So depending on your analysis and company preference and strategy, and with your data, you can make a good action and good judgment, right? Yes, and there's another example that I want to show you, right? So another job we perform in underwriting is like to change a lot of the underwriting guidelines for medical conditions. But we actually spend weeks of time and over months of time to change medical conditions guidelines because there are hundreds of the medical conditions. But if you look at this disclosure, top 8 disclosures we see from our underwriting data from different regions, you can find out where should be the focus, right? So if you look at the UK data here, already the top 8 conditions occupies around the 60% of the disclosure, right? So I would focus on only these 8 conditions to change the underwriting guidelines because that brings the impact significantly. So I don't need to look at 100 questions to update our underwriting guidelines. So with the minimum efforts, with the data insight, then I can maximize the impact of my changes already. And also one quick thing to mention in this slide is that maybe you already noticed that there are different patterns in disclosure, right, depending on the regions. So for mental health, you see it in UK and Australia, but in Malaysia, you see different things like hepatitis and thyroid. And this difference comes from different environment, like the mental health has different awareness depending on countries. And also in Asia, the access to the healthcare system is relatively easier in some of the countries. So you see more like a thyroid or breast lump conditions in the top disclosures. So again, to read the scene right and then to understand the story behind, you really need to understand your environment and what are really the risks and what is the change in your government healthcare system. So you need to have a holistic approach, and I believe it applies to pricing actuaries as well.
So what we have to think about is how effective are we at identifying, stratifying, and placing those risk factors as we go through that funnel. So here's an example looking at Australia data where we're looking at people who then have disclosures by themselves with the agent or go through a tele-interview, and thereafter they're selected for medical exams. There's pretty good STP rates in Australia. Up to 40–50% of people might get a policy issued at point of sale. The rest are referred to an underwriter, the non-medical limit's going to kick them out to medicals. So what happens for the people who go through both? The disclosures, and then the medicals, or the tele-interviews, and then the medicals? Well, as you would expect, we figured out the cause of weight gain, and it's filling out a life insurance application form. You fill out a life insurance application form, within 3 weeks of seeing the paramedical exam, 1 in 4 people gain 5 kilos or more. I shouldn't be one to talk. I had to buy a new shirt last week. I thought I weighed about 84 kilos. I went and checked afterwards, I weigh 87 kilos. So it's not always people are lying, it's what they honestly in their mind think. But when they go to the paramedical exam, on average, they become a little bit heavier. Some people are going to move BMI ratings from standard to substandard or from substandard to a higher rating. Likewise for hypertension, cholesterol. So in hypertension, a little bit higher between self-disclosed and tele-interview, but then a lot of people are going to find out during the medical procedure that they have high blood pressure or that they have poor cholesterol. Mental health, I left the box here for the paramedical increase because there's no blood test for anxiety or depression, but between the self-disclosed mental health and then through the tele-interview professional, a 66% increase in disclosures. So the standard rate between these three can't be the same, right? We put them all in the same pool. They're all called standard. They all get the same rate. And then as actuaries thinking about where do we find the sweet spot in the middle? A lot of underwriting, low rates, no underwriting, higher rates. It's optimizing what we see on the prior slides, thinking about what's the right amount of underwriting, both to get good risk rates, but to optimize conversions. So I'd also think about which journey optimizes conversions with the right risk rates. The less you underwrite, the higher conversions. The more you underwrite, the lower conversions. That makes sense. The more you underwrite, the better persistency. People keep the policies longer because they get time to think, do I really want this policy? So they get to sleep on that, and then they probably don't want to go through medical underwriting twice, so they keep the policy significantly longer than people get straight through.
Okay.
Sujin, we'll jump to the next case study.
Sure. Yeah, so the next case study is about the new data source, especially about the health and wellness data. So it has been a topic for a while because we always wondered how much predictive power they have, right? So what we did was like we built two models, and the first one was like this. So we built like two models in it. So the one model was only with the medical questionnaire data, right? And the other model, the model 2, is with everything, meaning like a medical questionnaire and the medical checkup data, and also the wellness, the well-being data, like steps, activities, yeah, and sleep data. So we compare these two models to see the value of this, medical checkup data and the wellness data.
So Sujin said, what happens if we do even more underwriting? Let's do the application form, let's do the physical medical, and let's add activity engagement wellness data to the picture. As you'd expect as actuaries, you get significantly more selection power if you were to do that. On the left-hand side, disclosures only, the spread between some of your best risks and some of your worst risks is only going to be about 2 to 1, from a 75% A ratio up to about 144. If you add medicals and activity engagement to the picture, you could offer significantly cheaper rates to 1 in 20 people. So 1 in 20 people, the difference between the worst types of risks and your best type of risks is then going to be 10x. So there's somebody who's going to get 10 times cheaper rates in theory. In practice, does this work? Can you collect it? Can you do it? Definitely the theory is there that if you collect all of this evidence, disclosures, medical, and wellness data, that selection power is there. Sujin, another way of looking at this?
Yeah, sure. So in the previous model, we already saw like, it's valuable. It's really helpful to stratify the risks, right? Then maybe the next question pops up could be like, then do we need the traditional underwriting, like application form is really needed when we have a medical data and the wellness data? So we wanted to answer to this question, and we built two models to compare. So one was the model with everything again, and the second model was only with the medical checkup data and the wellness data.
So Sujin said, let's take a look at getting rid of the disclosures. Just keep the physical medicals and the activity engagement data. Idea here is maybe you're sitting on a health book of business and you want to sell them life insurance very quickly. You wouldn't have to go back and ask about family history, et cetera. Do you have to ask, are you a rock climber, et cetera? What the data shows is you still need to ask people questions. If all you knew is physical medical, that they have good cholesterol, good blood pressure, and that they're very engaged in their activity, this AE ratio is 92%, which fits in about the middle of what you see on the left-hand side. So you get a lot of selection power out of just asking people questions. So maybe to my surprise, going from the US to Singapore, the best way to underwrite is just to ask people questions. We've got one more case study, Sujin.
Yeah. So the last case study is about the distributor. So as an underwriter, actually we talk with the channel people almost every day, especially in the direct companies. So we really understand them. So we have a sense like who is the bad guy, who is the good guy, right? So we want to take some action sometimes. Sometimes we want to penalize, sometimes we want to encourage them. But actually it's difficult to, objectively say who is really the best one, right? And also we are very cautious to take actions with the channel usually because it's also related to the sales performance, right? This is the common pain point that underwriters have. So what we did in our UK market was we worked with the actuaries together and we built the distributor score, right? So this distributor score is a ovary matrix about a few things like the straight-through process, about the standard groups, and also some disclosures on a few key medical conditions and some cancellation ratio and some lapse ratios, so we could actually compare some of the behaviors and patterns of the distributors, and we can make some judgment and actions. So Travis will show you some actual numbers.
So in this example, we're just looking at outlier distributors. We don't have a label here. What you could do is ideally get a label. You go through the disclosure process, you go through a medical exam, and then you've got a label of misrepresentation thereafter. Or you issue the life insurance policy and you go for additional medical underwriting after the policy is issued, which for example is common in the UK. Then you have a label, and you can do a labeled model of which distributors might be driving misrep. Here you're just saying, this distributor doesn't look like what I expect. So you build a model, given the characteristics of the customer that walks in the door, the socioeconomics, the demographics, the region, what do you expect the disclosures to be? What do you expect the straight-through standard processing rate to be? What do you expect out of early cancellations and early lapsation? And then you flag distributors or outliers. And then you think, what can I do with that? Do you do more underwriting reflexive to your distribution or to individual distributors? Can you cut them off to new business? Do you just speak to them and say, hey, this would be a lot more effective for everybody if we got honest disclosures at the point of sale, we could issue the policies faster. But the first thing is then to take a look at it and think about why that's happening. Sometimes you'll see outliers, and that could just be the case. They're very savvy distributors who say, I know that some of these people are not going to get life insurance at a good rate, so I just don't bring them in to buy the insurance in the first place. It's a little hard to definitively prove a good distributor via outlier analysis, but so long as you monitor somebody and they're in line with expected, then maybe you can target them for higher non-medical limits or incentivize them via campaigns that you might run or other measures in terms of increasing that distribution in your book of business. That's a summary of three examples.
Maybe I want to add one more point on the distributor use case. So as I mentioned earlier, so we know the channel better. So when we look at this data, like a disclosure rate or some cancellation or whatever, actually we should be really involved in interpreting those numbers, because in terms of the straight-through process rate, for example, like when you saw like a 51%, maybe you are not very sure whether that is a sensible number or not, right? But the underwriters know, because we know the underwriting system, philosophy in it, and what's the benefit, and what's the product. So we have a sense whether that is a right number or not. And also when you see the difference between actual and, the expected, like when it's like a 5% gap and 10% gap, then we can give you the view whether this gap is really okay gap or is too big. So we can give you the view. And also when you look at the disclosure rate, so the higher disclosure rate is not always something good. The lower disclosure rate is not always something bad, right? Because some channels, some distributors, for example, they only target some group of people, like sports clubs, right? Then maybe the health disclosures on smoking or mental, those conditions disclosure should be lower, right? So we can give you the full story behind, so that's why we need to talk each other, right? Okay. So going to the conclusion. So we want to conclude with a few questions. So this is a very familiar question to underwriters. So is underwriting on art or science, right? So I ask you to actuaries. So is pricing on art or science? What is your answer? If you read the intention of my question, then maybe you will easily answer both, right? Then the next question is what percentage is art and what percentage is science? Can you answer? Actually, we conducted a very quick survey on this in our booth out there, Pacific Life Re booth. And when I look at the result, it was interesting because the average percentage that the participants put in was quite same for underwriting and the pricing. So they said like 56% science for pricing and underwriting, and then 44% of art for underwriting and pricing. Same, it was quite similar number. And out of curiosity, I asked the same question to GPT, and then ChatGPT said 80% of science for pricing and 70% science for underwriting. Okay. Maybe. There's no right number, right answer. But from my view, what's more important is like maybe the art could play a playing a good role sometimes, right? Especially when you know, assume that like there are a lot of the data, everyone has the same data, everyone has the good talents, right? Then what makes you different, what makes your company different is the art part, how you interpret the data, how you read the, you know, the trend, how you read the behind the scene happenings, right? So that's why we need the more, good conversation with the pricing, because pricing and underwriting also, we have a different background, different touch point, different knowledge, so we can supplement each other to make a good judgment for the good art.
I guess I get in trouble if I put art in a pricing paper. I call it actuarial judgment. I do believe there's always going to be actuarial judgment, but the point is, I think we can pull more data out of that underwriting funnel and put a little more science into how we measure risk rates in the future.
Cool.
Questions?
Okay, thank you. So just to sum it up in 2 minutes, basically, that this presentation makes an attempt to see the behavior of distributor, the factors disclosed, and when I saw, first I will have a question, that in one of the slides when you're talking about distributor and you find that distributor's metrics are out of the range, you have simply cut off him from new business. Is it not a more mild action to reduce his new business commission? Just to give me an idea that, okay, you're doing something wrong. Your income is like that even in employment contract, you are giving notice for 3 months. You are not told that from next day don't come to office. So I think one of the option, don't you think, should be reduce the commission first, rather than cutting up to new business? And then if he continues that, then 100% you should cut off him from the new business. What's your view on this?
Well, it's as an actuary in reinsurance, I don't talk to distribution very often. What we have done lately is talk to some distributors, and it's enlightening that most distributors are honest. And so I don't know exactly what the right answer is. If you cut them off, that's not good. You got to write business, right? And you don't want to cut too many distributors off. They work in bigger agencies. They talk to each other, and they say, you know, don't do business with that company. They're very hard on distribution. And so I'd agree. You could probably got to figure out a soft stick as opposed to a hard stick with distribution.
We can take one question from the audience if anybody has some question, because our time is already up.
Come on, guys, acknowledge the knowledge. Ask questions. Anyone?
Okay, then we will sum up quickly. So basically, whether pricing is an art or science, I can tell you because I worked both in life and general insurance. For life, it is more science and less art. For general, it is more art and less science, because of the very basic fact that in case of general insurance, risks are heterogeneous. In case of life insurance, majority risks are homogeneous. Somewhere you have some different lives. But in case of general insurance, almost all commercial risks are heterogeneous. There it is more art. So with that, we sum up. Thank you very much for your patient hearing.